Markets faced some volatility second half of February and to start March. I've got 3 investment charts that puts the short term into perspective from the long term. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, there's a little bit of chaos going on. Markets don't like uncertainty, and boy, we certainly have our fair share of that. And yet, I saw this reminder recently, and I in talking to others and clients and whatnot, it's sometimes tempting to feel like, well, this time is different. And absolutely, it's different, but it rhymes, right, to the past. And so to help frame or put the short term into perspective, I want to look at a few different charts, 3, that were very helpful to me to help kind of, put some perspective on what's going on right now, but from a longer term view. First, it's not that unusual for the second half of February and even into March to be a little choppy, to say the least. And in fact, during post-election years, typically the first 3 months are very, very choppy. And if you zoom in on this chart right here, you notice that the second half of February, on average, is going back, this post-election years, going back, 70 years, 75 years. The second half of February is actually down. And into early March is actually, on average, it's actually negative. And yes, this is unusual, what we're all going through right now. This time is different, and yet it's not. Like, this is sort of fits the pattern. We'll see, but if you're seeing and feeling some of the volatility and some of the uncertainty and thinking, oh my goodness, actually this is sort of similar to actually what history has shown as well. So early stage weakness, late February and into March, choppiness to start the year in a post-election year, that's actually fairly normal. But that doesn't necessarily mean that it leads to, a negative year for stocks in the long term. You can see the average here. Post-election years tend to be pretty good on average. And so with a leg up in the summer, a little bit of uncertainty late summer, and then a leg up later on in the year. We'll see how this pans out. Obviously, there's a lot of change being commented and suggested, and so we'll see. But this choppiness, this start to us sort of fits what history has shown. Second reminder is that volatility is a feature, not a bug. It's a feature of being a long-term investor. This is one of my favorite charts. If you're a daily listener to the Wise Money Show, you've seen me share this before. And when looking back to 1980, so not a extremely long time period, but almost 50 years now, golly. On average, the market has declined each year from a high point to a low point. Not at some point was it down 14%, but from the beginning of the year, but from a high point to a low point. The average intra-year decline, 14.1% on average, okay? So if you've got $1 million in your portfolio, at some point, if your investments grew to $1 million, it's typical to see a $140,000 decline in your portfolio value. That feels like that could be concerning, right? That's actually normal. And yet, despite that volatility, we've seen out of the past 45 years, 34 of those 45 have been good years in the market. And if you look at the overall chart of how the S&P 500 has grown since 1980, it's absolutely where you'd want to be, where you'd want to keep your dollars invested to grow for the long term, despite this short-term volatility. So I would just point out and use this chart to say volatility is normal. It's scary because it's connected to real life events and real life concerns, and you think, oh, this is going to be it. And yet, oftentimes, markets are able to navigate that just fine. I'd also point out, even though that's an average decline of 14%, we certainly didn't see that last year, down just 8%, nor did we see it the year before, down 10%. And averages means we've got more volatility than that some years and not as much volatility as that in other years. And the average is out to be that 14%. We saw above average volatility the year before. So put your seatbelt on, but this is a feature of being an investor. It's not a bug. And then one more, just helpful perspective, because we're seeing, at least to start the year for the first couple of months, a change in the trend. And that trend is why it's important to stay diversified between U.S. and international investments. I know that is out of favor. That is an unpopular opinion. Going back decades and decades, it's important to have a healthy percentage of your portfolio towards U.S. large, mid, and small cap stocks, but also to hold some international stocks. And yet, that's been harder to hold on to. It's been harder to stay disciplined there because over the past, this is the longest time by a long shot that the outperformance has been so lopsided, and to that it's been towards the U.S. Take a look at this chart over the past 14 years, but then it's sort of even, and then we're back to another couple of years where U.S. has outperformed. That's the longest stretch ever that U.S. has outperformed international, or vice versa, right? And yet, with the extreme outperformance you can see here in this chart, we've seen that before. 277% outperformance by U.S. stocks over that 14-year time period. That is still less than almost 300% outperformance by international in just 5.6 years. It's important to remain diversified. And this year, at least at the time I'm recording, U.S. markets are choppy. International's been choppy as well, but international stocks outpacing large caps. So there you have it, a couple of charts that help put perspective, or at least to me, puts perspective for what we're experiencing short term, but from a long-term lens. And I'll leave you with one more chart. I told you only 3, but it's hard not to share this fourth one. It's my favorite, but hard not to share it in light of the uncertainty and a little bit of the chaos we've seen thus far. Just the benefit of being patient with your investments. And over, on any given day, it's a coin flip. Is the market going to be positive or negative? Any given day. But when you start stretching that out to, 10 days, a month, 3 months, 6 months, a year, the longer your perspective, or let me say it differently, the more patient you are with looking at your investments and reacting to them, the greater the odds of your performance being positive. And these are, what percentage of the time going back 100 years were your investments was the stock market positive over this time period. And yes, on any given day, week, month, even quarter, it can feel very random and very concerning. But you lift your eyes up from the short term to the horizon, and the longer your perspective, the greater your patience, the better the higher the odds that the markets are going to work in your favor. Stay disciplined, stay focused, make sure you've got a prudent investment approach, if not multiple investment strategies. That's what we prefer. That gives you greater diversification and helps, and is appropriate, it's consistent, helps with your long-term financial plan. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.